Hi, Larry. Can you hear me all right?
Yeah.
Oh, good. Thanks for the excellent presentation today. You made just at the very end, you talked about the points of why the motorcycle company is an excellent franchise. Would you mind just reiterating those one more time, please?
The features of this motorcycle company
that
I found so Berkshire-like?
Yeah.
Well, first, the source of the deal was from friends of friends, right? We didn't hire Goldman to go looking. Detlef Lewis hired a firm in Dusseldorf, and they went looking, and that person contacted a friend of hers in Omaha, whose dad was a friend of Warren's. And we credit Steve Foley from the Financial Times for digging all that stuff up. But that's the first thing. And the second thing is brand strength. Among motorcycle enthusiasts in Europe, Detlef Lewis is the place to shop. They sell helmets and belts and buckles and boots, and they sell other used spare parts, brake pads, oil, mirrors, and people in that world swear by Detlef Lewis. It has a very strong reputation among its employees and customers. I just mentioned the customers. On the employee side, in 2002, the company built a training academy to teach all of its workforce. They now have, I think, 1,500 employees. They teach them about what their customers want, how the product should be presented, how the business should operate, and you know the workers really appreciate that kind of attention. It has no debt, or virtually no debt, very little debt. There might have been $7 million or something like that in debt. And never really had used leverage. It was founded by a man in 1933 who owned it his whole life, and then shared it with his wife and his son. His wife worked there and did things, so it's very much. And then he died in 2012, so that was sort of time to sell. But it had been professionally managed for 15 years. His son was involved to a degree, but they recruited and installed a professional management team. They were very committed to the long term. They talked to private equity investors, but didn't like the idea of being flipped so soon. They also didn't like the intervention and leverage or fees associated with it. You know, and then I think on the economics, you know, they showed very strong profit margins, very strong, around 20%, very strong return on equity, around 30%, over long, sustained periods of time with very little cyclicality. They had once sold motorcycles, but they divested that part in 1997 to go just with accessories, which is a much more recession-proof, less cyclical kind of a business. And the price, I think it was 10 times earnings, 4 times book, 1.5 times sale, something like that. So it was kind of right down the middle. So the only thing that was odd about it was small. And but what Warren is saying is, I want to be able to introduce Berkshire Hathaway to Europe in the way that it's so well known in America, among people who advise families on selling businesses. And so to me, and you know, so I'm not making this up. I mean, he said, I want Berkshire to own a lot of European companies in the next 5 or 10 years. And so I'm just taking his lead on trying to envision that.
Hi, Larry. If you could, you know, you've been writing about Berkshire Hathaway and Warren Buffett for decades now. So what is the story? How did you come across Warren, and why did you decide to write about him? And the last, since you started writing about him and the essays and everything, did you, in the last 30 or 40 years, did you come across anybody else who was comparable, or nobody came even close to Buffett in terms of being the great manager?
My primary field was corporate governance and corporate finance, and I was writing an article on those subjects, and I stumbled across his letters. I think my own teacher had some familiarity with him. I think he knew him and had access to the letters. I started reading them, and I started to find them quite congenial, quite consistent with some of my ideas, some of my observations, which were very counter to the fashionable academic literature. Tom Russo referred to the seductive appeal of academic finance, and I was very much against that. Someone else, Bill Ackman, was talking about conventions and corporate governance. I didn't find them too appealing, so it was just a very congenial set of materials. And he also talks a lot about accounting, which is a great interest of mine. So I thought, man, I'm going to write about this. I'm going to write a book about this. And as I started to unpeel it more and more and more, I realized I couldn't do it alone. So I decided to have a symposium. That's what we do in the academy. I can't write all this. So I brought 15 of my friends together, and each of us took a part of the material to discuss. And so that was the genesis of that symposium. I knew it would be a great subject. I knew it would also be greater if he was there. And so did all my friends. And so I asked my dean if he knew Warren or anybody who Warren knew, and my dean said, I know I'm very good friends with Bob Denham, who is Berkshire's chief outside counsel. And so I'll put a proposal to him. I sent that through to Bob. He and I talked about it. Warren was on a trip to Asia at the time, so it took a while for him to get back to me. But when he did, he said, "This would be great. This is a wonderful idea." So we had the conference, and it was just it was a wonderful conference, a lot of fun, and the ideas were thick and rich, and we had traction, and the result was that book, and I just loved it, and it was just obvious that we should keep it up to date. So always have, and I think recently I wanted to really focus on this question that everyone has been asking for so long about what happens to Berkshire after Warren leaves the scene, which to me it was easy, but convincing other people is really hard. Running across other people, no, he's incomparable, as people have so often testified today. I do include some letters from Charlie Munger in the collection. I mean, that's about as close as you get. But, you know, each person, I mean, there are a lot of great people in corporate America, so I don't want to be condemning it. I think there are a lot of great leaders, a lot of visionaries, and going back to Lee Iacocca or Jack Welch, and today to Tim Cook. So there are a lot of great people. But these guys do have a singular, I think, philosophy. This partnership sensibility that they've drilled into this operation is unique. And I do think we can all probably learn a little bit from it.
How do you think they'll address the potential need for distributions down the road, either while Warren is still there or potentially after, in terms of the structure of possible distributions back to the shareholder?
Well, that's one unusual thing about Berkshire. I left out that it has not paid a dividend in 49 and a half years, and when they did pay that dividend, Warren said he was in the bathroom. But they've had a very clear test about it, about whether they can do better with a dollar for the stockholders than the holders could do for themselves, whether they reinvest a dollar and increase the market value by a dollar. So they've made that test abundantly clear. He's been able to meet that hurdle pretty much time and again, and has asked the stockholders twice in precatory resolutions, do you agree with this policy or do you prefer a distribution? And both times the holders overwhelmingly approved the policy. One was in 1994 or so, and the other was just a couple years ago. Might have been 2 years ago. So I don't think the holders, as a group, have a problem with it. Moreover, I do talk to people occasionally who tell me, boy, I really wish they would pay a dividend for all sorts of reasons. Some people have an appetite for liquidity. Others point out that some institutional investors are unable to make an investment in the company without a regular dividend. So if you did start to make a distribution, you'd attract more investors. I'm not sure that would be a good thing overall. They've worked very hard to cultivate a particular group of investors, and so I'm not sure if I would want to pay a dividend in order to attract a particular group of people. But there will be pressure, and Warren and Charlie are going to withstand any pressure they get on this topic. But after they leave the scene, the successors will face pressure, and it's going to be a little harder for them to defend it. They're not going to have, I think they will be given a grace period, but they will pretty soon be able to sustain the policy that we are able to reinvest a dollar to get that return. That's not going to be easy to do. But there may be some way to say we're sticking with the policy, but there is a portion of the cash that we should distribute. So that'd be my guess. But I don't want to advise those guys or second guess, preempt them.
Larry, you rightly pointed out that Berkshire has never divested a subsidiary, which immediately made me think that's partly because Warren and Charlie don't want to, but it's also partly because no one in their right mind would buy something that Warren Buffett was selling. How big an advantage do you think it could be to a post-Buffett Berkshire not to have Warren Buffett as the seller? Would it be easier for Berkshire to become more efficient and divest some of its underperforming subsidiaries?
If they did that, and there's going to be a lot of pressure to do that, they would jeopardize one of the pillars of Berkshire's unique strength. Being able to promise Mrs. Detlov Lewis, we will never sell, enabled him to pay 10 times earnings. If you can't make that commitment, you're going to start paying a lot more. And net, you probably are better off doing a lot of low-priced acquisitions and keeping a couple of companies that are hard to fix. So I don't think that would be a wise strategy. And that's the case that I think that the successors will need to make. And I will just clarify that they did sell some subsidiaries in the first 10 years that were dogs, and a department store in Baltimore and something else. And I would also add that some of the subsidiaries occasionally divest assets. BH Media divested an advertising pamphlet subsidiary last January, and they should be free to do so. And, you know, so those are divestitures. You know, Berkshire's on the other side. Maybe Warren's not on the other side, but I think it'd be possible to do this. But some of the troubled companies, you do wonder, and you can have legitimate discussions. You know, the Pampered Chef comes to mind. They paid $900 million for that at a time when it had $4 million in sales. I just saw some data the other day that suggests sales are a fraction of that. And that company is in trouble. NetJets is having a difficult time, and they've changed CEOs a few times. It's a capital-intensive business. It's very difficult. The pilots are very skilled workforce, but demanding on the labor side. So, but overall, the strategy has succeeded, and so I haven't listed that as one of my blemishes or one of my costs. I think maybe I should. It's a cost to pay. That's a great idea, Jason. Maybe I'll have a section on that.